I'm very pleased that we finished the year with a very strong momentum. We achieved a strong underlying profitability for the second quarter, for the fourth quarter, and also we saw clients confirming their trust in our organizations. 22 billion of net new assets, strong deposit inflows across wealth management and the P&C. We made good progress in winding down part of the non-core exposures, and also that has allowed us to then also reiterate the story that we are a capital. We want to have a dividend that is increasing progressively. So we have an increase of 27% of our dividend, and also in the second half of 2024 we will do a share buyback.
How would you describe 2024? I know your chairman has said in the past that it's a difficult year.
It's a pivotal year because if you think about the journey, the first 6 months are very intense. I think we're going to go through the merger of the two operating entity, UBS and Credit Suisse AG will merge in the first half of the year. The subsidiaries in the US and Switzerland will merge also during 2024. So this is the prerequisite to be able to realize our synergies. We already achieved 4 billion of cost savings, exit rate 2023. We now plan to have another gross savings of 9 billion between 2024 and 2026. Partially, this will be reinvested in the business to make our platform more resilient and up to speed with the requirements, but also to invest in our future.
So, Sergio, how important was this investor update, just to give a blueprint of the kind of growth that you want to attain, and how?
I think it's very important for investors to understand how we are connecting the dots between what we said in summer last year and in respect of our long-term plans, in 2026 plans and going beyond that. So today we are providing few dots between 2024 and 2026, how we achieve cost savings, how we manage our balance sheet, how we want to manage growth that has to come in a sustainable way. And also we give also some indications about what to look forward after the completion of the restructuring, which is then going to enable us to harvest, the work, and we did with a quite attractive returns.
So how will you achieve this quality, sustainable growth?
I think that one thing that we need to do is to be willing in the next couple of years to sacrifice a little bit of top line growth in order to improve the returns on our financial resources, particularly on the balance sheet. So I think that what we both was a very strong business in terms of client base, very good people, very good capabilities, but the balance sheet was not properly priced. We need to price risk in a better way, and that will help us to contribute to our financial targets for 2026 and beyond.
So exactly what does that growth look like? Is it a focus on the US or elsewhere?
Everywhere. I think that when you look at our wealth management business, we are planning to add around 100 million a year in terms of assets. This is basically the net numbers. We're going to want to grow more on a gross basis, but we are willing also to let some assets go that are not yielding what we believe is the appropriate level to cover for risk and capital cost. And then beyond that, we believe we're going to grow at around 200 billion. So if you think about what it is, we are recreating the business we just acquired. We acquired 700 billion of assets. In the next 3 to 4 years, we're going to build up organically the size of Credit Suisse again. So it's very important for us to do that, but in a sustainable way.
But for the US, for example, could we see an acquisition?
No, I think that the US, what we need to do is now to institutionalize our platform by giving more capabilities on deposits, on credit. We need to broaden up more of our global expertise in terms of CIO offering products, the asset management capabilities that are coming in. And what we need to do is also to allow and make it easier for our non-US clients to book business in the US, because a lot of our global clients They want to be also booked in the US, and this is a real opportunity. So we believe that by doing that, we're going to be able to narrow the gap to our competitors and setting the base for the next phase of growth.
Sergio, when you look at dividends and buybacks, how important was it that this was ambitious or sufficiently ambitious for shareholders?
I think is the beginning of a journey. The journey. So the fact that we are increasing our dividend by 27% is a good message of confidence. Share buyback are coming. We want to be prudent in the way we look at share buyback. We want to complete the first phase of the integration of the legal entities in 2024. But it's to give a little bit of a flavor for where we want to go. By the end of 2026, we want to exceed the levels of capital returns we had before the acquisition. So I think that it's just a testament of our confidence and our ability to generate capital over as we also manage the integration.